Okay, Jayesh, we'll leave it at that. That's an insight into how the market has been panning out so far. But let's shift focus and let's talk about, after the recent correction, what is it that you should be doing with your mutual fund portfolio? Dhirendra Kumar from valueresearchonline.com joins in on the show right now. Dhirendra, hi, good morning. Good to have you on the show after quite a long while. Wanted to understand, Dhirendra, what is it that you've made of the recent market correction? While life doesn't change for SIP investors, should they be topping up their portfolios, though, in this current decline?
Everybody should be topping up every year, or whenever anyone's income rises or your expenses go, your scale of saving rises. Yes, one thing I would like to say that many investors came through the they did set up their SIP, and they got chasing recent past performance is always the case for most new investors, and small cap funds that have fallen the most. But the lesson to take here is that despite the relatively highest decline of 7% over the last 3 months, one will still be sitting on a gain of nearly 30%. So I think investors should just keep calm, carry on, invest more as and when they can, and they should not try and increase it as and when they can. Or, they should not do it in any manner which is linked to the market. You should, and make sure that this is the money which you don't need for many few years.
Yeah, absolutely. The other thing, Dhirendra, also is, in these uncertain times with crude, with inflation and geopolitical crisis all creating havoc, do you stay with the safer ones, have a higher allocation to large caps? I know it's not easy to try, change your allocation every now and then. But are you safer there as opposed to the broader markets of mid and small caps, which have seen a bigger fall?
No, it is a futile exercise, because whenever you try and attempt that, this is the allocation which will be relatively stable or safer. In fact, what I noticed that the large caps were the most vulnerable, because FII sell out and their mainstay is large caps, so that is where we saw the biggest decline. The larger mid caps or the small cap, they turn out to be relatively more stable at a certain point. And we haven't seen the carnage in the small cap, at least in the set of holding that mutual funds hold. So one should not try and attempt that, fine tuning of your allocation. The whole idea of a SIP is that I would say that one should choose carefully to begin with, or somebody should be guiding an investor in the right vehicle, which may not be happening at a large scale. Simply because if somebody is a first-time investor and somebody who is 40-year-old should always start with something which has a significant fixed income allocation, because all long-term story and everything is fine, but you are faced with a 20% decline of your investment in a brief period of time. It is quite unnerving. So choose your vehicle carefully to begin with. And that is needed only for the first 2-3 years. After that, the acclimatization of the investor, he gets used to it and understand that, okay, this is the way of life. And this is the state of the market, and it is always going to be like this. People don't, and that is why it turns out to be a higher compounding vehicle, because it is not going to be a nice smooth line all the time. And another thing is that we don't find too many disappointed investors with the decline, because the scale of SIP, which we just understood, which we just discovered, that the scale of SIP reported by AMFI is far lower, because many of the new platforms that have which have come about, they are taking SIP, but they actually they have given the choice of choosing a date of a date which investors like, and technically they are not getting reported as SIP. So what is happening is, and we came to know only recently when Parag Parikh actually stopped taking money in its fund, and but continued taking money in the SIP, and many of the investors, their investment stopped going into the fund. Then they discovered they are actually registered as a one-time periodic investment, regular investment, but not reported as SIP to the fund company. So the scale of regular investment in Indian mutual fund is far higher than it is being reported.
Hi, Dhirendra. Good to connect with you. Hope all's well. I read
All
through
well,
that.
Nikunj. Thank you.
So what could be extent of this? I mean, I was speaking to some common friends and they also mentioned that the number coming by MFI is not the correct number. What do you think the actual SIP number is if you put everything together? Is it almost double of what MFI number is?
No, it will be about 15 to 20% because, but it will keep rising if it is not getting fixed because, and one has to look at it in terms of the monthly inflow, which is non-SIP. I think, a definite part of that is going to be SIP. So, the SIP reporting might get increased by 10 to 15%.
I'm going to change gears and we spoke about equity because that's where all the volatility comes in and we get into debate, right time, wrong time. There's always a good time to start a SIP if you're a long-term investor. But debt in this kind of an environment, Dhirendra, when you know interest rates will go higher, when you know that inflation is going to be the bugbear for high interest rates, how does one approach debt for next 12 months, 18 months?
I think, always, more so post Franklin, post the big shakeup that we saw, the big scare that the debt funds created, and investor experience, they got stuck. Of course, fortunately, most investors have been able to recover nearly all their money. So it has not turned out to be disappointing, but it has scared very much. And debt is not something. I don't invest in debt for those kind of adventures. So one should be averse to, and that cannot be ruled out, given the economic turbulence that we see, and the companies. Of course, the scale of problem that can come in on the credit worthiness front may not be very high because Indian companies are far less indebted today. But I don't think it is worthwhile. Interest rates can go anyway, and in the last 6 years, I have seen that before that, I've never seen a situation that most investors, most fixed income fund managers, they used to think in a standard way. Everybody will think alike. And that will eventually materialize. Many a times, 90% of the fund managers will think that interest rates are likely to go up, are likely to go down. And that is what will happen. Last 5-6 years, they have mostly been wrong. Most of the surprise that has come in the way of fixed income managers has caught them by surprise, and that has hurt investors in the short run or medium term. And we see massive flows moving from one fund to another because most funds are open-ended. People square up their losses and move to something else. I think investors should keep it very simple and should keep it very safe. It is not, one should not assume any degree of anxiety with the fixed income fund, which is, limit yourself to short-term funds and choose the funds appropriately and ignore the rest. And there isn't a very strong case for long-term fixed income investment today. If at all, then you should look for the appropriate fixed maturity plan as and when it comes by to lock into. But why will anybody lock into to relatively lower interest rates today? If there is a likelihood that it can well may go up.
You buy today, interest rates go higher, you want to lock at higher rates. So Dhirendra, what about, let's say, buying an arbitrage fund in this kind of an environment? You know volatility is back. It's not a one-sided market. It is not going to be like a crazy bull market of 2021. Does it make sense to, let's say, move towards arbitrage fund? I mean, because the whole proposition of debt was 7-8% safety return, which in a sense was assured. Which is that category which you think can give you this kind of a promise?
Arbitrage funds have actually, the return of arbitrage should be benchmarked to a liquid fund. And I think they turn out to be reasonably okay because, if you are able to earn, and they have been able to generate somewhere close to what liquid funds generate. The big advantage is that it's actually, the arbitrage is on two fronts. One is the tax arbitrage, because if you invest in a liquid fund for that concessional tax treatment, you have to hold it for 3 years. Arbitrage fund, you just have to hold it for 1 year and you are eligible for 10% tax rate, tax on gains. Even less than 1 year, it is 15% short-term capital gains tax because technically it is, or tax-wise, it is treated as equity. So in that sense, it is worthwhile for any large investor who wants to keep a large amount of money on the standby for some investment or spending or whatever, to actually invest in arbitrage fund for that reason, and don't expect anything substantial from these. Because of the scale of arbitrage fund, and also because of the increasing technology, people investors embracing technology. So arbitrage by their very design are self-cannibalizing. The arbitrages get killed, but extreme volatility might create some such situation, and that is why these funds are able to create reasonably closed, sometimes little more, sometimes little less return than liquid fund. They're attractive for their tax efficiency.
Morning, Dhirendra. Avan joining in.
Good morning.
What
Hi,
would
Avan.
be the ideal strategy? Investors who are looking for some sort of diversification, they're uncomfortable to buy stocks at high valuations. Time horizon of, say, 3 to 5 years, long-term wealth creation, would balanced funds be the way to go?
No, one should even be a little more concerned, because your idea should be to beat, inflation, and maybe earn a little more, but you may not be, with a balanced fund. Balanced fund is actually tending to, what used to be erstwhile balanced fund. I'm referring to aggressive hybrid fund, because we don't have too many balanced fund options, attractive options, because everybody has launched a balanced advantage, and SEBI does not permit you to launch a balanced fund as well as a balanced advantage, because of balanced fund by the very design, or by the definition, are supposed to be 50% equity and 50% debt. If we had too many attractive options, it would have been worthwhile. And the erstwhile balanced funds are not a good, they are tending to be almost an equity fund. Be more conservative, be with a balanced advantage fund or a equity saving fund. And one has reasonable, good choice there.
And how do you reckon one should look at appropriate allocation in, categories like equity, mutual funds, gold, real estate, and deposits?
I have been, not a gold believer, but there might be a small case, but it should not be significant allocation to gold. And equity and debt, it's entirely a function of how well you are able to take the big swings in your stride, and also when do you need the money. If you need your money, whatever part of it, in the next 3 years, keep it in the fixed income and keep it very conservatively. Don't try to maximize the return on fixed income investment. And one should not be investing in fixed income with a intent of a maximizing return. Just think of reasonable return, optimizing return, and nothing. And when choosing a fixed income fund, I would like to share one thought which every investor should be very serious about, which is never invest the best performing fixed income fund in the category. It is an outlier for a reason, and the risk will visit occasionally, and that will be very scary.
Thanks very much, Dhirendra, for spelling it out so
Thank you.
explicitly as to what investors should do in an environment like this when it comes to mutual funds and appropriate asset allocation. All right, it's time for a quick break right here on the show. We're up 6:50.